The IMF usually plays it pretty safe when it comes to politics. The U.S. is the biggest shareholder in the fund. I think there's a lot of concern about the Trump policies.
You know, I'm not sure this is politics, though. This is economics, right? So at least one hopes it is. And there's two kinds of people in the world. There are people who believe in the fabulous qualities of the Trump tax cut and those who don't. And yesterday we heard from the Federal Reserve, and at least to this point, they don't. And you find that by looking at their long-run growth path, which is between 1.8 and 2%. They see 2.8 this year, 2.4 next year, going back down to trend of around 2. I haven't seen the growth numbers in the IMF, but they don't apparently see that either, which is probably why they see the deficit ticking up so much. The administration believes there are positive qualities to this tax cut that echo into the years. They include a boost in capital spending, which should boost productivity, and they think they can raise the overall potential of the economy, and that will pay back dividends. They have 3% built in. My guess is the IMF and
half.
I know the Fed.
It's half.
What's that?
The IMF sees half of what the White House sees on projected growth over the next few years. Yes.
That would be very low, which means they do not really see much at all. Because you did say that they saw some positive aspects.
Modest.
They apparently see that going away. I can look that up, but the bottom line is they see back down the trend, and you have the bill left over from the tax cuts.
What is the IMF's track record when it comes to forecasting?
You know, as good as anybody else. Yeah. Nobody's very good out there when it comes beyond, say, the first year or the second year, but not any better or worse, I would offer, than the administration.
Half of what the White House expects on growth, Joe. Which camp do you favor?
I would correct Steve. Because the administration hasn't been around long enough. IMF's forecast, to Melissa's points,
I meant
are just terrible.
Joe.
Well, you said administration,
yeah,
but
you're right.
Thank you. Okay, thank you.
Fair enough.
But look, IMF's forecasts are terrible. So I wouldn't put a lot of stock in what they're saying. And it seems to me, from what Sarah just mentioned, there seems to be a tremendous political bent to it. So I hope they're wrong for a lot of reasons, but I wouldn't put much stock in their numbers.
Are they the only ones who seem to be alarmed about the debt? I mean, it was a topic 5 years ago, 10 years ago. It was all anybody talked about. Now, the past 3 years, it hasn't been talked about much.
There are reasons to be worried about it, but I mean, the financial markets are telling us that right now it's not a problem. There are countries that have much worse debt ratios, such as Japan. I mean, why don't they worry about them? I mean, the U.S. is, relative to some of its partners, not in such bad shape. The issue for me is growth. Can we get growth faster? And in turn, can we get that revenue share to GDP higher? If we get the growth, that'll solve a lot of problems. To me, it seems like it's worth a shot. I just find the IMF tends to be way too fiscally conservative with an axe to grind, and these policies may work. They may not work, but it's worth giving a shot. And I'd argue on the corporate side, there is permanency here. These aren't temporary.
Yeah, but Joe, how do you get there? I mean, I'm all in favor of getting there.
Sure.
And the trouble is the economics are very difficult, right? Our demographics are locked in. It's really hard to raise that number, which is going to give you, what, less than a percentage point from demographic growth, which means you got to get 2 points out of productivity or better.
Right.
Do you see that happening?
It's certainly possible. I mean, there is the productivity growth when it changes trend, people almost never see it. And there is a case to be made, I believe it, that we could see a sharp acceleration in productivity. That would be it. If you don't get that, Steve, you're correct, then you'll get these weak numbers. But again, the administration plan was designed to lift the supply side of the economy through capital deepening and investment and deregulation. Kevin Hassett's estimates are that it'll work. But again, we'll see. I mean, sometimes these things can widely miss the mark.
You know, the IMF, it's putting the IMF aside, Joe, this is one of the biggest debate on Wall Street right now. We were having it with Bob Pisani and Steve Liesman earlier, and that is how long, what is the sustainability of this growth spurt that we are seeing, which looks pretty good and is fueled by tax cuts and deregulation and some of the administration's policy. Yes, they get credit. The question is it front-loaded? And by 2023, is growth going to go back down to 1.4%, as the IMF says it is? There are a lot of people that think that's going to happen.
Well, Sarah, here's the thing. These debates have been going on for a long time. This isn't new. It happened under Reagan, Bush, Clinton, Obama, and now Trump. So it's not new. Look, business cycles don't die from old age. They die from imbalances. So the tricky part is finding the imbalance. For me, the big risk is the Fed. And I look at the yield curve. I look at what the Fed's doing. I don't like it. It's a real risk that the Fed chokes this business cycle off. If they don't, there's nothing to suggest, Sarah, this can't continue. I don't want to say indefinitely, but for another few years. I mean, Australia hasn't had a recession. This one last point. Australia hasn't been in recession since the early 90s. I mean, these things can go a long time.
Joe, I want to get your policy prescription correct here. So you're saying higher growth is possible, even likely, but the Fed should not be raising rates in the face of that higher growth. It should stay down.
That's exactly
well
right.
below. You think 2% or so or less is the right funds rate for economy that's growing real 3%, which means I think you are thinking a zero real funds rate is what is the right funds rate. And I'm sorry, there's a little skepticism in my question. It's warranted. That's my point.
Yeah, no, that's exactly.
It's weird,
that's
right?
Exactly
you want
right.
a zero funds rate.
I want to see them run the economy
on a 3% real.
Yes, I want to see them run the economy hot to try to engineer a cyclical lift in inflation, which they haven't basically seen since the early 90s, and see where it goes. Yes.
But we're there, Joe. We arrived at that too.
We're not there on inflation. No, we're not there on inflation. The core PCE and headline have been consistently below 2% for this cycle and for the better part of the last 20 years.
I've been arguing with Joe on the same point.
It's
an optimistic take.
But let's look at the. But I mean, the PCE is what they focus on, and it's not been running above 2%. I mean, that's obvious.
Okay. Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.